Switch conversation, start talking fundamentals. Deepak Shenoy, CEO at Capital Mind Mutual Fund, joining us this afternoon. Deepak, always great chatting. Let me first take it and talk to you a little bit about Reliance Industries. In terms of the move itself, uh, we're starting to see some momentum in the counter. Talk to us about this entire shift that we are starting to see towards monetization of the assets that they've built up, whether you call it telecom. I know new energy may be some time away. What do you make of it, and how quickly can they start to reap the benefit of the investments that they've made? Give us a sense.
So I can't specifically talk about individual companies, unfortunately, because our compliance won't allow us.
Sure.
But in general, I think large conglomerates, when they start looking at multiple businesses, the problem becomes: are you a holding company, or are you an operating company that has multiple, perhaps non-connected investments as well? We've seen some of these investments actually divest by splitting their company shares, by, I mean, in a sense, demerging from the larger entities. And I expect that to happen. That's in the best interest of shareholders. Otherwise, you do something like a large FMCG major has done, which is to demerge in some way, but the holding company still owns a significant stake of this demerged entity, which creates a cross-holding issue and overall does not add meaningfully to analysis of how a company effectively generates consolidated profits. So I think in general that in large conglomerates, they should be value creation by demerging. Once they've reached a certain size and they're independent of their own, I would say I hope this will happen. This will creating large monolithic entities is not useful. Have a single holding company if you may, but have individual operating entities at different ends. And I think in general, the idea has been use the cash flows of one positive entity to finance the growth and the investment into another business, which is relatively new. I think in most of these cases, that can still continue to happen. But once that investment has yielded fruit, that has reached a certain size, then you should have it independently listed. And I think the sum of the parts here will be greater than the whole. It's very difficult to analyze and whether it's a large auto company kind of a structure or something in the oil and gas space, like you said. Now they've all become conglomerates. I would rather see them as individual, differently listed companies owned by the same promoter group, perhaps, but operating independently of each other.
Okay, so Deepak, that's the view. And since you've spoken about autos, the auto index, auto sales numbers have looked very good for the month of December. But the Nifty Auto Index has also registered a fresh new all-time high today. So that looks very good. But Deepak, the other big story yesterday and today that's been playing out in the market is the tobacco space and some of the cigarette stocks. What do you have to make of this excise duty announcement that's come over and above what the street was estimating at large? And what do you think the impact is going to be on some of the biggest tobacco and cigarette players in the market?
So in general, I think there have been two layers of threats. First, people have reduced smoking in general. I think the overall numbers and volumes over a long period of time have grown lesser and lesser every year, and I think they will degrow as time goes by. There's a second threat in the form of alternatives such as vapes and all that stuff, which is illegal right now in India, but of course still widely available. In some cases, they are actually better than cigarettes in terms of the health issues also, but I mean nothing is good here. Everything is just a different category of bad. But as people get more health conscious, as people perhaps use some of these other products, the ability for the government to extract taxes out of just cigarettes, beyond it being just something to tell people don't smoke, we're going to tax this product increasingly as it goes by. I think the idea is that the tax revenue from this is going to dwindle, and the companies that are solely focused on cigarettes as a revenue source should consider diversifying into other sources, because I think this is a tough this is going to be tougher and tougher to get both margins and growth in. And as you degrow, your fixed costs remain the same, your margins will effectively come down. And I think over a long period, a lot of things in India will also change. Loose cigarettes are being sold. They're not sold like that in most of the countries. So we will go towards that. So people have to buy full packets. That will, change cash flow characteristics as well. Places like the US and most of the developed countries, cigarettes are substantially more expensive than they are in India, even with all these taxes. So expect taxes to get higher and higher, and therefore, hopefully, some of this will convince people to get off cigarettes and make it a healthier society in that sense. But I would say that is why this is not such an exciting space. It's an addictive product by definition, and to some extent, that addiction has kind of fueled a lot of ROEs so far. But when the addiction becomes a problem and when people start addressing it either through higher prices or through health conscious efforts, then you're going to see this number decline. I think this number is going to continuously be in a decline. So the companies need to use their cash flows to diversify into non-cigarette based, maybe FMCG, maybe hospitality, maybe a few other places where they could actually leverage their larger reach in distribution to a more effective way than cigarettes alone.
Deepak, what's the take with regard to some of the QSR names? For the longest time, they haven't done much, and except, of course, the market leader in that space. What do you make of the move that ought to come, if at all there is a turnaround? Are you expecting that at all?
To be honest, I think QSR has taken on different hues. What was a quick service restaurant is now quick service offering through the restaurants themselves, using even the non-quick service restaurants offering their products on these apps that you can use, that you can quickly order from. So I think every restaurant has become a QSR in some way, but just that you don't have to go to that restaurant anymore. So the formats haven't meaningfully changed, but I think there is a lot of space here for more authentic brands to come in. And so these current companies also, which are largely American brands that have been brought to India, maybe some of those, the owners could actually build some of the other brands. In the biryani is the largest selling food in India, except none of these, there's no biryani brand that is listed as a QSR in any case. And it's very conducive to having QSR because the formats of making, the formats of delivery, the formats of giving it to customers is fairly largely automatable, and like they have in QSRs done. So I think over a period of time, there's going to be a lot more competition in this space. I don't see, therefore, that you should give large valuations to them. Once they start reaching stable cash flows and some ROEs, I think you can evaluate them in that way. But I feel at this point, most of the QSR listed players just tend to be a little more expensive, and for the potential competition and growth dynamics that you're seeing on their specific brands, I would say I await a larger and more competitive marketplace in the QSR space, and I think more will come here. The current set of players, while they've been able to garner market share and keep their presence going. In the long term, I feel the competitive pressure will be much higher, and therefore, fundamentally, I would say a little word of caution on valuations. That's the bigger thing that I would be worried about.
Deepak, stay with us. What we'll do is slip into a very short break. We'll continue talking with regard to Deepak's views of the market, but also on a couple of stocks which are really making news, including the likes of an L&T. Silently, it's crept up, sitting at its 52-week high. We'll get a perspective on that on the other side of this very short break. Stay with us.
Deepak, any take on this entire infra / cap good theme right now? We've had that electronics manufacturing scheme, this third tranche of it also get passed today. One of the beneficiaries over there is Dixon. Any thoughts on electronic manufacturing, overall industrials, a broad theme or a broad outlook over there?
Yes, absolutely. I think there is a huge move towards, there are two things of this, right? The PLI and the incentives that the government is giving. And secondly, lower interest rates after RBI cut rates in December that will help, I think, propel capex even better in some of these fields which are asset heavy in that context. I think both of these things will add up and help EMS companies, and apart from EMS, I think a lot more in the electronic industry. There are lots of parts of the electronics industry, whether it is LEDs, diodes, or at the fabs and chips. There's a whole array of things that you can do, and a lot of these things I think have been waiting for some clarity on a US deal and all of that. But our domestic requirements itself have, I think, propelled a lot more of these investments to come in. For instance, the auto sector does want less dependence on India for some of these requirements, and that the manufacturing of almost all parts of that ecosystem, from PCBs to chips to a number of other electronic components, can be done in India. It's not cutting edge. It doesn't need to be some 4 nanometer or something as small as that for building a chip that sits in your car. It can be something that can be manufactured in India, and as much as that domestic requirement itself starts getting fulfilled, both for domestic auto companies, for defense, for a lot of other use cases that are being enabled domestically as well. I think the scope over here is massive, but it's a 10-year project. It will take us a lot of time to acquire knowledge, machinery, and build a lot of the components that are required to get a lot more of this done domestically. The investments have just started to happen. I think we saw some commentary in the last quarter that we are seeing early signs of this capex coming in from a lot of sources, not just the pure EMS companies just themselves, but from a lot of other sources as well. And I think in December, when the companies start announcing their results, we will start seeing a lot more of this commentary coming in, even from companies that are perhaps in auxiliary spaces, buildings, construction, infrastructure investments. They will have a component of electronic components that will have to be procured, and much of that will also be manufactured domestically. We've seen the railways already start to move strongly in that direction. Defense is anyway, it's a prerequisite in a lot of cases that the supply chain is in India, and I think a lot more of this will happen going forward. I look forward to more announcements and some more commentary when companies announce results. And I think this is a massive, massive space going ahead.
Deepak, how are you looking at power and that entire ecosystem? What within that ecosystem are you liking? Those big projects or rather, a large aspirational 30 gigawatt announced by NTPC, obviously over a period of time, 2 gigawatts set up by 2032. Is this something that you're keenly monitoring as a decadal theme, an early decadal theme, and how would you play it, especially on the nuclear power side of things?
Yeah, I think it's difficult to figure out who's going to win in nuclear power, because a large part of this market is still controlled by, say, an NPCIL, or to a certain extent, a lot of our nuclear research itself has not easily been translated into private and listed players. But there are people who are using it. So, for instance, you have NTPC that you talked about, that is building, that is adding reactors in places that it already has, infrastructure in terms of land and all that stuff. There are some the older projects that are getting upgraded, adding more reactors. There is some work that has been happening for the last decade on thorium. So we don't really have a currently way ahead, but I think creating more breeder reactors eventually that can generate uranium for us to use in other reactors as well is also some part of this process, and that will actually help the ecosystem kind of build more nuclear energy into that system. It is going to be a relatively small part of our total energy production, even in 2040. So you have to think of this not as a decadal theme, but like the next 30 years. It takes 10 years for a reactor to be built and completely operational from that perspective. So it'll take a lot of time for any of these things to actually take fruit. Till then, you might concentrate on the companies that make the parts for the reactor because they are the ones that benefit initially, and eventually it's the power companies, the distribution companies downstream that will benefit. I like the distribution theme a lot more right now, though we're starting more on power generation again after nearly a decade of not really meaningfully increasing capacity, because the constraint was not the capacity, the constraint was transmission. We didn't have enough transmission for last mile to be able to use the grid more effectively. Now I think the grid is way better than it was 10 years ago. So we should be able to upgrade a lot more on the last mile transmission layers, which is currently still missing. Most of India, and I know in Bombay you probably never faced this, we still have load shedding. And that is a problem that India needs to solve in the coming decade. So I think that is going to be first and primarily addressed. So a lot of companies down that line, companies manufacturing meters, companies manufacturing last mile equipment, doing projects around that, those will probably benefit more meaningfully in the near term. Nuclear, I think, will be a very useful thing to bet on once some of these projects are a little bit further down into this thing. And our idea of this nuclear deal, bringing in these smaller modular reactors, some and technology transfer in India when it comes, then I think more players that will focus on that space will be visible, possibly new ones as well. So I would say transmission first and nuclear power generation next in the investment cycle.
Very detailed takeover there. Thanks so much for that. Osho, let's welcome Osho Krishan, Chief Manager and Technical and Derivative Research at Angel One, joining us on the show. Osho, good afternoon, and wishing you and your team a very happy new year. Thanks for joining with us today. While Osho, we're talking about the theme, about this entire power generation and the shift from solar to thermal. The one stock that's been doing very well today from the thermal space is Coal India. A fresh 52-week high for the stock, a 6.5% jump on the back of the news flow that they are going to also allow foreign direct investment in their e-auction process. So that's a positive for the company. But on the charts, Osho, how is Coal India shaping up?
Very good afternoon to all of you, and firstly, wish all the team members a very happy new year. Well, yes, no doubt in the recent period we have seen a very strong traction in Coal India, but that was quite expected, specifically from the last trading week, because there has been a strong consolidation breakout, and now the counter is at a very strong movement. It has seen a kind of 6 to 7% kind of a movement in intraday. So I expect the momentum is there in the counter, and after an elongated period of consolidation, the counter has given a very strong breakout. So the immediate target or the potential upside target for this counter is nearly 440, which will be the short to medium term target for Coal India. While on the lower end, again, 400 to 410 is expected to cushion any kind of profit booking, and that should be considered healthy also, because in today's trading session, the counter has given a significant uptrend. So I expect that any kind of correction should be auguring well for accumulation purpose. Immediate target is standing around the zone of 440, and if it breaches the zone of 440, then again 465 to 470 will be the next potential target, but that's from medium to long term perspective.
What about, thank you so much for that, Osho. Kunal, what about an NTPC, that 3.5% move? Does it change anything on the stock?
Yeah, it does. In fact, this is the third consecutive day of price uptrend for NTPC. And you don't see these stocks behaving like a high beta stock. In 3 days, 10% kind of a move. That's that's one-off for stocks like NTPC. And that generally happens when you see a new trend emerging for the stock. So had it been just about NTPC moving up higher and most of the other peers not moving up, then we could probably have taken this as a one-off price action move, maybe on the back of some sort of a news flow, etc. But then when this comes as a synchronized move across many power names, now you look at Torrent Power, that stock is up 5% approximately, has come back towards a 3-month high, and in a very similar kind of a way in Power Grid, etc., which have come back towards the day's high as well as the multi-week high. So that strong move across the board indicates that this could be a near-term trend in the making. But then I believe that it's always better to not buy these stocks at the peak of momentum and just wait for another 2-3 days. There would be a point where in the next 2-3 days these stocks they cool off a little bit, and that's where I think traders should start chipping in.
Okay, so that's the take on some of the power generators and that theme. But Deepak, talk to us about what you think quarter three has shaped up for some of the smaller banks. We've had updates trickling in from multiple names like Indian Bank, Tamil Nadu, you have South Indian Bank, and these updates look good prima facie. And in fact, AU Bank is also at a fresh all-time high. But without getting into specifics, Deepak, your take on within the financials basket, what could have outperformed the rest of the basket in the quarter gone by?
I think PSU banks have probably done fairly well. There's a lot more happening in the areas where the reach is more. We're seeing a lot more. If you see the RBI banking stability report as well, you're seeing that margins are contracting for the large private sector banks, and perhaps margins, are reasonably stable, for public sector banks, and especially where because the margins have always been lower, they have not seen a meaningful hit there. They're also their deposit franchise is a much more broader in that sense. And although they have a lot of small customers, they are able to deal with the migration from CASA much easier, much in a better way than perhaps the private sector banks are. So I think they should do relatively better this year. And because of relatively larger holdings of government securities as well, I think that government security bump happened in the last quarter or last week of December. So there will be some kind of treasury gains as well that will come in. So I think overall they should do better. In general, banking is still suffering from relatively low credit growth. You're having low nominal GDP growth. You're having relatively low credit growth, 10% or so. That hasn't improved yet. And I think the biggest hit of this will happen in the private sector area. But the smaller private sector banks, they seem to be doing much more interesting things because they seem to be partnering with both some of the new age players in terms of providing the back end for apps that would kind of reach a distribution potential in cities and tier 2 towns and tier 3 towns. That adds a lot of focus. So some of the smaller private sector banks are also something that I think I think we're going to see a good positive quarter from them. The larger ones, I don't see any meaningful growth here until the the overall bank, the overall sector growth itself in terms of total credit given from banking improves to a 13 to 14% level. Right now, it's not happening. So I would say at this point, my expectation is that muted results from large private sector, decent results from smaller private sector, and possibly good results from public sector banks.
Osho, where do you stand with regard to this private sector versus PSU bank debate for 2026?
See, overall, PSU banks have already seen a very strong traction. Majority of the counters are near their lifetime highs, but private sector banks have not done that much as compared to the PSU banks. But still, I'm positive on both the sectors. Even the private sectors banks are looking quite positive to me, and I'm expecting that momentum can be seen in the large players in the coming period. For example, ICICI Bank have seen a decisive correct. It has been into a decisive corrective phase from the zone of nearly 1450. But looking at the historical and broader time frame chart, now it is placed at a very strong support level. So I'm expecting that from here onwards, there can be a decent bounce, but these can be seen as a pullback in majority of the private sector banks, while PSU banks are into a strong momentum. So I will rather prefer picking up momentum calls for the time being, although the private sector banks are also looking good with a strong risk reward ratio, but momentum still prevails with the PSU sectors as well.
Okay, Kunal, there's been positive news flow on Aurobindo Pharma today on the back of an acquisition, and that stock is flying and doing very well for itself. Your take on Aurobindo Pharma and stack it up against some of the other pharma majors. Which one looks more attractive on the charts?
I think this is a very good chart in the making, Aurobindo Pharma. I was actually looking at the charts, yesterday when I looked at, the triangular pattern for the stock, a consolidation for the last, I think it's the 7th straight week where the stock is, stuck into a trading range. But then the week prior to that, consolidation started off. That was in the month of November start. There was a big up move for Aurobindo Pharma where the stock moved from, I think, 1100, 1125 to almost 1225 in a matter of just one odd week. So what it did was that strong single price uptick move for Aurobindo Pharma led with almost 7 weeks of consolidation. and now the stock seemingly is trying to come out of this consolidation. So I would actually expect the stock to head towards at least a 100-point up move about the 1220, 1225 mark. So would look out for 1325 approximately as a near to medium term target. Now, in that sense, most of the other pharma names are actually just about going through a sideways range. You look at the charts for Lupin, Sun Pharma, Cipla. These stocks, have more or less just about gone through a consolidation. The only other two charts from the pharma pack which are looking slightly bit more better and again preemptive of a breakout. One would be Glenmark Pharma and the other is Biocon. I think both of these stocks are now stacked up pretty well, and compared to this, I would believe that large cap stocks would try and just about consolidate or go through a range bound kind of a price action.
Very interesting. You know, the other one, Kunal, on our radar, and we spoke about it this morning as well, Ola Electric. That stock has gone electric. It's up 9% in trade. You spoke about it this morning. You said that you wouldn't place any bets at this point. Does anything change?
Not really, Harsh. So yes, even after this 9% up move, it's typically a very high beta stock. When I try and compare this with the other names, there are far better options which are available. You look at Hero MotoCorp, the stock, opened with a gap up around 5,900 plus levels and moved towards 6,000, 6,050 mark. Eicher Motor has been doing phenomenally well. Maruti's come back towards a fresh lifetime high. So there are far better options, far stable charts. You might want to just about play these stocks for a couple of days in terms of trading, but nothing meaningful change has happened on the long-term charts. The major resistance the stock has to climb for the charts to significantly improve for Ola Electric would be around the 55 to 58 zone. So till the time the stock doesn't cross above those levels, I would avoid this name specifically from a long-term investment perspective.
Okay. Osho, what is your take on some of the city gas distribution names where we understand that there has been a trim in the prices, and there has been a trim on that front, but that momentum is reflecting very positively on names like IGL and MGL. Good move over there. So if you could give us your chart check on some of those names, and what's your take over there?
Overall, there has been some positive traction in the last couple of trading sessions, but overall the trajectory is still on the bearish front because most of the counters are hovering near the short-term moving average, 20-day exponential moving average. So I'm expecting that if there will be any kind of decisive movement in the coming period, for example, MGL is having a very strong resistance around the zone of 1160. So better to wait for those levels to get crossover. Then from there onwards, we can see some kind of pullback from a short-term point of view. So one should take a pragmatic approach. One step at a time can be seen in these counters. For MGL, 1160 will be the potential resistance. If it breaches the zone of 1160, then 1200, 1220 will be the next potential target for the counter. So one should wait for those levels to get breakthrough and then can look for buying opportunity.
Yes, okay. Just getting sad news through. We have come to understand that the managing director of Equitas mutual fund, Equitas fund has actually passed away. Siddharth Bhaiya has passed away on the 31st of December. He was on a family vacation in New Zealand, is what we're told, and he has, unfortunately left us, and that news coming through as well as we speak. Yes, Deepak, let me come straight back to you, back to markets. Unfortunately, show must go on. Talk to us a bit about autos. Where do you stack up? The numbers, at least in terms of the auto sales, were extremely strong. Do you feel that, is there a preference that you have within that auto pack? And what within, and how would you play it actually? Would you play through auto ancillaries? Would you play through the OEMs?
Yeah, thanks. Sorry, I'm a little flustered. I just heard about the news, and my deepest condolences to Siddharth Bhaiya's family. This is really sad news. So from an auto sector perspective, my views, largely stem from the cut in GST that happened in September. I think that has made four-wheelers a lot more affordable. Four-wheeler affordability has increased largely because their taxation rates were among the highest, and relatively speaking, in absolute rupee terms, that changes in a few lakhs, the difference between the prices, what they were earlier and what they are now. Secondly, with the drop in interest rates, I think EMIs will become more affordable. So I think both of these factors will keep helping people buy more four-wheelers as they go by. And given, the harsh climatic conditions and the environment, issues that we're facing, people will upgrade from two-wheelers to four-wheelers for comfort as well. And as they get economically better, I think that will be something that will happen to them. Unfortunately, the sector itself has taken about 7 or 8 years to kind of recover from a cost that was added to them by the Supreme Court in terms of bulking up on insurance right at the time of sale. So 3 to 5 years you have to buy insurance at one time. That increased the cost, and because it was relatively price sensitive, so it took a long time for sales to come back. It has now finally come back to that level. I think two-wheelers will be next, because the first vehicle for transportation will likely still be two-wheelers. Commercial vehicles, I think they'll go through a different route on this. A lot more electric two-wheelers, electric commercial vehicles will be on the roads. Here, some of the contracts are still going to relatively newer age players, so it's not easy to bet on any of the listed players on this front. But I think four-wheelers and two-wheelers, there's definitely listed players that are taking the bulk of the efforts that are, the growth that is happening here with their distribution networks and with their ability to now get more technology. And some of the technology that we're using now in cars, in the Indian-made cars, is actually quite fantastic. We're competing very well with some of the foreign cars as well, and with much lower price points. I think there will be a lot more demand. So my order of function would be there. The four-wheelers, two-wheelers, and then commercial vehicles. I think tractors will primarily depend on the monsoon. So if this year is not an El Nino, then I think tractors will do well as well.
Okay, Deepak, appreciate that view, and thank you once again for joining us on the show, and thanks for your time.
Thanks so much, and Happy New Year to all of you.
Happy New Year to you as well.
Thank you.
Well, viewers, while we're talking about